Welcome back, everyone. I'm Simon Severino, your coach. Today we analyze a stock that's in my portfolio. It's called BlackRock. Most of you are wrong about BlackRock. I will show you what's actually going on in BlackRock, a company that's in my portfolio. It's in the income part of my portfolio, but it's a really, really high quality company, and it fits really well our data owners and pricing power thesis of our portfolio. So if you're new here, we want to double your net worth every 3.8 years by growing your portfolio 20% CAGR year over year. I'm doing it in front of you live. We are on track. We are at our fourth doubling. It's 2024. We are at $1 million. We are at $1,076,000 right now of this live portfolio that I'm sharing with you guys in our community. If you're not in our community, join our community. I share the full portfolio and the live trades there. It's at strategysprints.com. Join our community if you are not already in there. We are on track. Let's double your revenue. No, let's double your net worth in the next 3.8 years. Let's get this party started. We want to talk BlackRock, and here it is. The reason why I bought into BlackRock after watching them for many, many years, because professionally I had to do with the company. This is my reason. Ticker symbol BLK. It's a dividend stock. It owns public market data and it dominates that field. It's an asset manager with $10 trillion under management. So asset under management, 10 trillion. The second best, I think Apollo is around 1 trillion. Blackstone, I think it's below $1 trillion. So they are by far the leader in their field, which is asset management. But I love them as a data owner. They own public markets data. They bought iShares from Barclays many years ago, and it was probably the best acquisition in history. When Barclays was in distress, they bought iShares, which is all this ETFs business, and they are adding to their public markets data also alternative data, private equity, private credit data, because they recently bought GIP, which owns core infrastructure, so airports, bridges, things that basically no private company can buy, because when you buy an airport, you need to maintain an airport. So it comes with operating costs that only somebody of this size can actually carry. They earn, and that's a moat, right there. So we have the data moat, then we have the infrastructure moat. Now we have some financial moats. They make 40% operating margins, which is wonderful, gives them a ton of optionality. They own a distribution network that's incredible and creates strong network effects, stronger than their next two competitors, and they're absolute number one by far. I think they are 10x number one. So then the next thing is they have network effects, and you know we love network effects. When you have network effects, you are unstoppable. Try to get off Facebook, you will get back because of the network effects. There is still people using the fax machine, not because it's a great product, but because it had network effects and they still vibrate. Next reason why I bought, it's capital light. And when you're capital light, you have more optionality and higher profit margins. So let's go to the financials. Is free cash flow per share really increasing year over year? Is the operating income really increasing year over year? Is the return on capital employed really increasing year over year? Let's see. If we look at the financials, let me pull my pen for you here. It's a bit mixed, but overall, the profitability was growing very, very strongly, and it's now stalling in this last period. And the operating income is not growing fast, but it's reliable. So this is a boring income stock. In my portfolio, it's a defensive stock, but I really like it because recently they went into niche markets. One that I'm following closely is the Bitcoin market. And so they are the leader also in the Bitcoin ETFs. They were the leader in ESG. Now they don't care about ESG anymore. Now they go into niche, into private markets and into niche new asset classes that are emerging like Bitcoin. So they are really, really aggressive and want to win. I like companies that want to win. And they are capital light, high quality score, 94 of 100, with strong growth and strong momentum. They are fairly valued right now at $757 is what I consider fair value. And in Q1 2024, only 3 gurus bought them. It's not my most followed gurus, so I don't really care. This is a stock that not many people are buying right now, and if they're buying it, it's in really small sizes. So we are onto something here. If you are seeing this, you are seeing alpha right there. What you do with it is your decision, but now you have some numbers and you can speed up maybe your research process. If you're looking for an income asset, this might be an interesting play for you. So they have a data advantage, they have network effect, they have Aladdin, which is becoming an industry standard. And I did a quick comparison to Vanguard and State Street. And if you look at that, you see that they lead in almost all categories that are important. They have a higher moat than Vanguard and State Street. They have the same switching costs. They are low for everybody because you can move asset managers easily. That's not a problem. But in terms of pricing power, they are all medium. That's because of the switching costs. And the networks effects, they have the highest network effects because of the Aladdin platform. So this was BlackRock. If you want our live trades, make sure you join our community. Go to strategysprints.com and click community. Join us. We are 24/7 in Slack together. You can tag me, you can tag other amazing people, and together we grow faster and take better decisions. Keep rolling, everyone. See you on the other side.